double entry accounting, we're now moving on to look at the impact of revenue and expense transactions in double entry accounting. We're going to exclude GST transactions for the moment. The first transaction on the 1st of March is providing a service to a cash customer. This is for a service business, so this would not apply in a trading type business. This is a very simple revenue transaction for a simple service business. Think about an accountant providing a service to one of its customers. They receive $6,000 cash for providing that accounting service. The two accounts affected are the bank account and the revenue account, which in this case we'll call takings. The double entry accounting rules say an increase in an asset is shown by a debit entry. So we debit the bank and we write the name of the other ledger account affected, which is takings, and the value, which is $6,000. That's the debit. The credit goes to takings. Takings is the revenue account. An increase in revenues is shown by credit entries. That's one of the double entry accounting rules. So we write the date, the name of the other ledger account which is affected, and the value of the debit there equals the value of the credit there. The second transaction is to do with an expense. Paid wages $1,500. That's going to affect the bank account and it'll affect the individual expense account, which in this case is wages. The bank must have gone down because we just paid out $1,500. So to reduce bank, it's a credit entry. That's one of the accounting rules. So I put the date in there. I write the name of the ledger account affected, which was wages, $1,500. So that's the credit entry to reduce the value of bank. Wages is an expense. It's gone up from nothing to $1,500. Double entry accounting rules say that must be a debit entry. So you put the date in, the name of the other ledger account, and the value, which is $1,500. So the value of the debit equals the value of the credit. The value of the debit always equals the value of the credit for any transaction. In total, debits always equals credits. Next transaction, of course, we're excluding GST, remember. We're paying rent $2,700, so that must mean that our cash assets have been reduced. So we put the date of the transaction, we write the name of the other ledger account, which is rent, the value, which is $2,700. That's a credit entry. That's reduced the value of bank. And into the rent account, this is an expense. We want to increase the expense, and the double entry accounting rules say to increase an expense, you put it on the debit side. So 3.3, the name of the other account is bank, and the value was $2,700. So you've debited rent to increase it, that's a debit entry $2,700, and you've credited the bank to reduce the bank $2,700. The value of the debit $2,700 equals the value of the credit $2,700, and we're still in balance. We move on to the next transaction. This is a cash sale of stock, so this is a trading business type transaction, and just to make it easy, we're going to leave out the cost of sales for the moment. So we've sold stock to our customers and received $1,000 from those customers. So that means our bank must have gone up by that. So we put the date in, we write the name of the other account, which in this case is sales, and $1,000. So $1,000 because assets have gone up by $1,000. Cash assets up $1,000 because of revenue. And to increase revenue, the double entry accounting rules say it's on the credit side. So you credit sales, and the amount there is $1,000. So the credit entry there, $1,000, matches the debit entry here, $1,000. The total value of the debit equals the total value of the credit. This next transaction, which relates to the previous one, does refer to the cost of sales. So what's happened? We've got rid of some stock. We've sold some of the stock and it cost us $400. So to reduce stock and asset, we have to do a credit entry. So we credit the stock account and we write cost of sales on the credit side, and we put the amount, which is $400. That's reduced the asset. And cost of sales is an expense. So we're going to increase expenses by a debit, and the cross-reference is going to be stock. We really should call that stock control if we're very fussy, and the debit there will be $400. So the value of the debit, $400, equals the value of the credit, $400. Assets reduced by a credit, expenses increased by a debit. Come back for the next video.